on to get his master's and PhD from Stanford in business administration from the School of Business.
This is Christ.
He's had the opportunity to deal with lots of different companies, lots of different businesses, both acquiring them, starting them, and then selling them. So he has a vast knowledge of many different industries and businesses. And he started even, my favorite when I was speaking to him earlier today, started an ice cream business in England. So he's got a lot of experience in his belt. So I'd like to welcome Dr. Ken Woolley.
Is that going to work? Can you hear me okay? It's okay? Okay. I thank Dean Anderson for inviting me and Mike Klauser to come and talk to you today, and I hope it'll be interesting and helpful. I assume most of you are business students, or if you're not, you're planning on having a career in business, even if you're not a business student. As Jake mentioned earlier, as an undergraduate, I studied physics, and I wasn't initially intending to be a business person, but I got religion and switched and ended up being a businessman rather than a physicist. But I still have a great fond love for physics and science, and it's been something that I've had some passion for all of my life, but I haven't really pursued it much in my business career. As was mentioned earlier, I have been involved in a number of different businesses in my life, and I've been an entrepreneur much of my life. Tonight we're going to talk about one business more specifically, and the company's called Extra Space Storage. First of all, I'd like to ask, how many of you in this room are not from the state of Utah, by raising hands? Okay. Do we have anybody from California? No California. Anybody from the East Coast? Okay. In places not in Utah, you will see self-storage as a business in greater abundance than you will see here in Utah. In Utah, our business is often referred to in a derogatory way as storage sheds. And just to tell you a funny little story, I have a business partner today whose name is Spencer Kirk. He's currently the CEO of Extra Space. And in 1998, when I tried to persuade him to come into business with me, he said, "Ken, that's a seedy business. I don't want to be involved in that." And, you know, I hope none of you want to be involved in seedy businesses. He said, "You know, you're driving down the freeway and you see a chain link fence with some concertina wire, and you see some old cinder block buildings with a gravel driveway, and you drive around to the front of the place, and there's a guy in a tank top with tattoos, smoking a cigar, holding a shotgun, with his guard dog overlooking your stuff." And that was his image of our business. And so I took him to Los Angeles and to Boston, where we were building some beautiful modern state-of-the-art facilities, and he saw a very different business. And many of you will be entrepreneurs, and many of you will start businesses, and some of you may fail in your businesses. I have failed in some of mine. Before we get too started on the self-storage business, I just want to say a few things about being an entrepreneur. You've got to have the personality and the drive and the desire. Not every one of us is cut out to be an entrepreneur. And the reason for that is you have to have a high tolerance for risk and a willingness and ability to recognize that there's a lot unknown in the future and that you might fail, and then even when you do fail, you have to be willing to get up and try again. And some of us are not cut out that way. We don't like to do that. We like security. And so we may not want to be an entrepreneur. I've always said that the most successful entrepreneurs start their companies between their age 30 and their age 40, because people who are in their 20s generally don't have enough experience, and they often fail because they make mistakes because they just don't have experience. They have a lot of energy, a lot of enthusiasm, and not a lot of experience, and they end up flaming out too fast, or they start a small business that really doesn't go anywhere. And after age 40, often people become too conservative. They get houses, they get mortgages, they have children, they have obligations, and it's very difficult to get rid of that nice salary and the benefits they have from the company they're working for, and it's very hard to leave and start their own company. And so there seems to be a sweet spot of time. And what I want to say to you students is that if you want to be an entrepreneur in your life, don't worry about starting your company tomorrow. Worry about getting yourself prepared by going into a related business or some other place that you can learn on somebody else's dollar how to run a business. Because you learn a lot in business school, but you learn a great deal in the practical world of business that you can then apply. Secondly, I want to talk about some concepts of integrity and honesty. I always believe that in your business life, you're going to be much better off if you get involved in a business that's positive for society, for mankind. Which really means, do you really want to be in the pawn shop business? Or do you really want to manufacture cigarettes? Or do you want to do something that's going to be harmful to other people? Even though it might be legal, it may not be really moral. And there's a lot of businesses like that are very profitable. But I would just counsel you to stay away from them. Do something that's good, that's honest, that's reputable, that doesn't hurt. You're not taking advantage of somebody else when you're doing it. You're not creating a Ponzi scheme. You're not taking somebody else's money for something you're not giving good service or value for. And just remember that when you kind of take the high approach, you'll be able to keep your head up high. You'll be able to feel good about what you're doing, and your life will go a lot better. I've always believed in having partners. It's another aspect. Some people don't like to have partners, but I like to have partners. I find there's sort of two kinds of entrepreneurs. One is the egotistical entrepreneur that creates a kingdom. And the king is he's the king or she's the king. And everybody else are the serfs. And they work for the king. And the king is all about aggrandizing himself. And the business is all about his own ego and his own, how good he is. We all know people like that. I don't need to name them. But I think some of the greatest businesses have been founded by partners, people who've worked together. Usually, a single entrepreneur doesn't have all the skills that he needs to put together a business. And if you can find someone who matches your skills or is opposite your skills that you get along with, it's a lot more fun. There's a lot of problems in starting a business, in building a business. And when you have someone by your side who you can work with and talk through the problems that's on the same level as you are, rather than being a serf, so to speak, you have a lot, you can solve the problems easier. Secondly, when you have good times and when things are great and when you have success, it's a lot more fun to share the success with a partner than just all by yourself, so you can brag, well, look at what I did. This is a great company. I did all this. So I found in my business career, every business I've been involved in, I've been involved in quite a number, I've had a partner. And I've enjoyed working with partners. And it's been a fun thing for me. So there's just a few principles. Dean Anderson asked me to talk about Extra Space and it becoming a great company. This is our annual report this year. I should have brought a box of them, then you could all take a look at them. But Extra Space Storage, the best at getting better. That's our motto this year, the best at getting better. Meaning we're never as good as we could be, and so we're striving to get better and better every year, and that's kind of our goal right now as a company. But let me tell you a little bit about the history of how this started. It's like so many businesses. the entrepreneur or the person who started it sees an opportunity. I first worked in the self-storage business in 1969 when I was at business school at Stanford. I worked for a local real estate developer who was building self-storage. He had seen the idea in Texas, and I worked as an intern in his office. And we built a property, or I didn't really help him build it, I kind of watched him build it, was there while it was happening, on the Bayshore Freeway in San Carlos, California. And it was very successful. It was the first one built in the peninsula of San Francisco. And it leased up in about 4 months, and his return on cost was about 25%. I think the whole project cost him $1 million, and he was earning $250,000 a year in net income, cash flow, per year off this property, which is pretty phenomenal. Well, I put that in my back of my mind, and when I finished my degree, I went to Boston, and I worked for the Boston Consulting Group doing strategy consulting and working for large corporations, and I noticed there was no self-storage in Boston. I thought, well, why isn't there? It's got to work in Boston if it works in Menlo Park. Well, I didn't have the means or the ability. I was in my late 20s. I soon moved to another company in Wyoming, which was a small family-held company in Cody, Wyoming. And I tried to convince my boss to, let's look at this self-storage business. Maybe we should get into it. So he said, well, you've been a consultant. Why don't you go do a study? So I did a study, and I went to Los Angeles and looked at every storage property in Los Angeles. There were 26 storage properties in Los Angeles. Today there's over 4,000 in the greater LA area. Can you imagine that? I didn't have the total vision at that time. But I came back and I went to Texas and Phoenix, and Salt Lake actually was an early place where they were being developed. Do you imagine why would they be developed early in Salt Lake? Anybody have an idea? Well, Utah people tend to be entrepreneurs. And any new idea that happens in the United States, whether it's a franchise or some sort of a business idea, gets to Salt Lake very early because there's so many entrepreneurs per capita here. It's a great place for entrepreneurs. I think we have more entrepreneurs per capita in Utah than any state in the United States. And that's good and bad. The bad part of it is that Utahns are cheap. And they don't like to pay for anything. And everything's about price. And so it's great if you have a product or service that you can sell outside of Utah to somebody else. Like WordPerfect was founded here, and software was sold all over the country. Novell was founded here. Adobe Software has a big operation here. But all those products are sold outside of Utah. They're not sold to the Utah consumer. It's very difficult to open a business here in Utah to sell your product or service to the Utah customer because the Utah customer is so cheap. So that's one of the reasons I think that self-storage started first. It started here early because there were entrepreneurs that saw it right away, and they built those chicken coops and called it storage sheds. And but anyway, finally I convinced my boss to build one in Billings, Montana. I mean, now Billings, Montana is not the garden spot of real estate development in the United States. But we built one, and it leased up in 1977. And I thought, this is a good business. I want to get into this business. I was interested in it. And I finally quit my job and was hired as a professor at BYU to teach strategy. And I made a deal with the dean. I said, okay, I'll teach 2 days a week if I can have the other days to do what I want to do. He said, okay. So I took a 2/3 salary cut, went to BYU in 1979, and started, and with one of my buddies, we have to have a name, you know, when you start a company. The name Extra Space came from a close friend of mine. We were brainstorming, and he came up with the name, and we founded the company, used the name, and started developing self-storage. Well, what do you need when you start a business beside an idea? What else? Money. Real estate developments cost money. And I didn't have any money. So if you don't have any money, where do you get money? You got to have someone to invest, don't you? Someplace, something. Well, I had met people in California that were interested in this, and I thought I can get them to invest, and they had agreed to maybe put some capital up. And I was very fortunate because my previous employer, who I had left as employee, came to me afterwards and said, you know, we'd like to back you. And they did. And they became my partner. And they invested $7 million over a period of the next 2 years as a 50-50 partnership with me. Now, why did they do that? I was only 31 years old, just starting out, because they trusted me. I'd worked for them for 5 years. I was a little like Jacob that worked for Laban for so many years to get his wife, Leah, and then later Rachel. I worked for this family for 5.5 years, and I didn't get Rachel or Leah, but I did get a financial backer who believed in me, and that was wonderful. And they were wonderful partners, except, unfortunately, a few years later, their company went broke due to some unfortunate circumstances, and I found myself partners with the Bank of Boston, not with my previous partners, which meant that we had to liquidate everything we had, and I didn't have a partner anymore. So during the 80s, I was kind of scrambling around, and I made a bad mistake. And if you're going to be an entrepreneur, don't make the mistake I made. At the same time, I got involved in a mining company, a house building company, and some other small ventures. And so I was doing self-storage, and I was building them, and I soon opened up in Boston and sent my brother-in-law, who became my employee and later a partner, to Boston to work there, where there were no self-storage. I had seen that. We started developing in Boston. We then started developing in Chicago. We then started, and also in Southern California. And I had figured out by that time that if you're going to do it in big cities. Because in big cities, it's where people have money, and the rents are higher, and the return is better. So we started building in these places. But it was always a problem raising capital. And so I spent an inordinate amount of my time putting together little limited partnerships, going out and raising capital from private individuals, and then I would sell properties. At the same time as I was building my small little company, I was building 4 or 5 properties a year. Each of them cost $3 or $4 million. So it meant that we were having to raise equity capital and we could raise debt capital, but equity capital of $3 or $4 million a year, and it was hard. And so I would sell properties in order to make a profit to reinvest. There was a big company called Public Storage. Many of you have heard of it. It's our biggest competitor today. They're the largest. We're the second largest company. They were growing very rapidly by tapping the public markets to raise capital. So I made a deal to sell properties to them. And this was my deal. You know, self-storage, one of its negatives is that it leases up very slowly. If you build an apartment complex, and I built many, you would expect to lease your property in 6 to 9 months, maybe a year at the most. Self-storage, you expect to lease your property in 2 to 3 years. So there's a long period of lack of cash flow before the cash flow finally stabilizes. And this time frame is agonizing for the entrepreneur. Well, I made a deal with Public Storage. Look, I'll sell you the property for, say, $5 million. You're expecting a cash flow of $500,000 a year, but right now there's no cash flow because it's brand new. So I'll guarantee the cash flow for the next 3 years while it leases up, and you'll pay me enough price that I can put money in the bank to cover this negative guarantee. That was our deal. Except I personally guaranteed it. So then, some of you remember there was a guy named Michael Dukakis. Remember him? He was the governor of Massachusetts. He ran for president. And he ran for president on the back of how the Massachusetts miracle was a great economic miracle, except the Massachusetts miracle in 1989 and 90 turned into the Massachusetts bust. And so did my self-storage properties that I had sold to Public Storage. And in 1990, I found myself on the other end of a guarantee, and they called me up and said, "You owe us $275,000. And in 1990, we couldn't get any financing to do anything, and the banks were about ready to strangle me, and I didn't know how I could stand it. And we had borrowed money from First Security Bank here in Utah to build properties in Boston and Chicago. And then the regulators came into First Security and said, hey, what are you lending money to this guy, this Utah guy for to build over here? You've got to get that money back. And they wanted to foreclose, and it was a tough time. They never did foreclose, and we got everything worked out. But meantime, I had this bill, and I couldn't pay it. And so I went to them, and I said, look, I can't pay the $275,000. I don't have the money. By the way, this is what you do when you don't have enough money. You're much better off going and facing your creditor. And they said, okay, we'll make a deal with you. You sign a note, and we'll give you some time, pay us some interest, and you work it off. And they actually hired me to go to work for them as a consultant, and my money would go to pay the note off. Well, in 1993, another entrepreneurial venture of mine paid off. We went public in a company called Megahertz. I had some stock. I sold the stock. I paid all my debts off. I was feeling great. And now I'm going to fast forward here. This is Extra Space today. Because today we're public on the New York Stock Exchange, $48. Well, today I think we closed around $49 a share. We have a dividend of $1.60. Total return for 2012, 54%, 120 million shares outstanding. Total equity market cap, 5.75. Right now it's about 5.9 billion. Actually, this is an error. Total debt about $2 billion. This is the history I'm talking about. In 1994, I made a big mistake. I sold most of our portfolio to another public company that had just gone public that year. And we had about 30 properties, and we sold them. And for the first time in my life, I had some cash in my jeans and was feeling pretty good about life. But then I found I didn't have a company anymore. I'd sold all but 3 of my properties, and I had this tiny little office. I thought, well, what else am I going to do? So I started building again. But then something happened. I had long stopped teaching, but BYU had called me up and asked me to teach a course on strategy for the winter semester of 1998. And I hadn't taught for 6 or 7 years. And so I knew I had to bone up on strategy. I mean, I hadn't read any books or any cases or anything for a number of years. Hadn't been thinking about it kind of conceptually. And that Christmas vacation, we had a family, we went on a safari to Africa, to Kenya. And 3 days before we were to leave, I slipped on the ice here in Utah and broke my collarbone. And I was in a lot of pain. So we went to Africa, and I had a broken collarbone. And my family went out looking at wild animals and things, and I sat in camp reading books on strategy. And that went on for day and day. I mean, I read the whole textbook. I read every case. I really refreshed my whole thoughts about business strategy. And as part of that, I started thinking, you know, Ken, you have a bad strategy. You have been in house building, and I had started an ice cream manufacturing company. I had been involved in a high-tech company we took public. And, you know, one of the principles of good strategy is focus, right? Strategic intent. Did I have strategic intent? No, I was just all over the place. I was like, bleh. That's how it was. I wasn't having any strategic intent. And I wasn't focusing. And another thing is that you should use your best talents, or the company's best talents. In other words, what are you good at? Or what is the company good at? You should use those as your strategic advantage. I wasn't using that. I looked at myself as like a company, and I said, what's my strategic advantage? Well, I know everything there is to know about storage. I know how to finance it. I know how to build it. It's a great business still. Why aren't I building a real company? And I sort of had a revelation, so to speak. And I came home from Africa, and I walked into our office. There were 8 employees in the office. Today there's 250. I said, we're going to build Extra Space into a big company. We're going to stop. I'm going to try and focus my energies on this company. And it was a big for me, it was a big change of life. Well, I knew that I needed two things to do that. The first thing I needed was money, and the second thing I needed was a team, because I didn't have a good team. It was kind of a small business. We didn't have good management. It was sort of a, anyway, I needed a team. I thought, well, how am I going to raise the capital? So I hired an investment banker, a small investment banker, a woman, in fact, who's now on our board. And she worked for Arthur Andersen Real Estate Capital Markets Group, part of the Arthur Andersen company that later went bust. We put a little package together, and our objective was to raise $50 million of equity for doing deals. 50 million, that seemed like a lot of money to me. At the time we had 8 or 10 properties. And she took me on a road show. We met with 21 different institutional investors. And guess what? I got proposals from 8 of them to give me 50 million or more. 7 of them wanted to buy a majority of our company, the money in. And I thought, wait a minute, I'm trying to build a company that I want to build a company. I don't want them to buy it from me before I've built it. So the one company that didn't do that was Prudential Real Estate Investors. Prudential Real Estate Investors is an arm of Prudential Insurance Company that raises capital from pension funds and then invested in real estate. They agreed to invest it on a joint venture basis with us, where they would invest directly in properties, but we could hold our company separate and just joint venture with them. $50 million of commitment, pretty good, and it was a good return for us how it was structured. Well, I had Prudential on the line. Then I said, well, I need to have employees. I knew I needed a CFO, so I went out. And we worked hard and we hired a CFO. His name was Kent Christensen. I wanted a partner that I felt could do better management than I could do. I knew that I was good at deal making, raising money, strategy, but I knew I was bad at managing and running the day-to-day and holding meetings and just holding people accountable. So I worked with a guy named Spencer Kirk, who's now our CEO. Spencer had been very successful as a high-tech entrepreneur. He was 15 years younger than me. At the time I was 52, he was 37. He had sold his company, made a lot of money, been very successful, and retired at age 36. Bought himself a nice plane and some ranches and was enjoying his life. And I went to Spencer. I had actually coaxed him into investing in a couple of deals with me to drill an oil well that failed. And we were riding back from the oil well this day, and I said, Spencer, I've decided I'm going to build Extra Space into a real business. And he said to me, oh, the storage business. And then he was the one who told me about the guy with the tank top and the tattoos and the whole thing. And so I said, no, come with me. So we went to Los Angeles, where we just completed a beautiful property in Sherman Oaks, California, 3 stories. Really, and we built a brand new one and a couple in the Boston area. They're really nice. When he saw what we were building, he recognized that it was a good business. And after some coaxing, he agreed to come in as my 50-50 partner. He put up substantial capital, and we formed the new Extra Space Storage, LLC. And at the same time, we brought Prudential in and merged all our little partnerships in a big joint venture with Prudential. And Prudential initial capital contribution was $50 million. Well, that got us started. Well, then Spencer said, well, what's our goal? Before I tell you that story, after we closed, I asked the guy at Prudential, I said, why did you invest in Extra Space? He said, because I knew we were pretty small for them to make an investment like that. We're a Utah-based company, we're not in New York, we're not in California. And he said, we checked you out. We called Public Storage, and they told us about you and how you were good for your word. And the guy at Public Storage had told him that I had this guarantee and that I ended up having a problem and I owed him $275,000 and that I agreed to pay him, and that I took a note and I paid him off when I said I would. And they said, you know, we did the same deal with a number of the other entrepreneurs, and Ken was the only one who paid us off and did what he said he was going to do. And that was great, because Prudential, as a result of what I did, kind of with my own integrity at the time, Prudential made a decision to invest $50 million. It later became $100 million, which later became $2 billion. I'll explain that later. Well, I thought about that a lot, because I knew at the time that that whole thing happened with Public Storage, I was not happy. I thought it was their fault. It didn't lease up well. They didn't manage it well. It's their, I shouldn't have to pay this $275. But then in my heart of hearts, I really knew the problem was the recession. It just happened to be a recession, and that's what happened. And I got caught, and so I owed them money. And so I lived up to what I said I was going to do. And it was hurtful. It was very hard for me at the time. Well, it kind of made me smile when Prudential made a decision, a $50 million decision based on that phone call. So you never know when you're in business how something, this is 9 years later, how something 8 or 9 years later, that something unrelated can come back and either help you or hurt you in your business, of how you've behaved, what you've done. So just remember that. Well, Spencer said to me, my new partner, well, let's build the company to $1 billion in assets. That's our goal. And we're going to try and eventually we'll become the largest real estate company in Utah. That was our goal. But we didn't want to build and operate in Utah for why I told you. Okay, that was our goal. Well, and this was the 5-year goal. You need to set goals. We set that goal, $1 billion in 5 years. This is 1998. 2003 comes around. Are we at $1 billion? No, we're not at $1 billion. We're at $600 million. And we've been working hard. We've been raising equity. We burned through what Prudential would give us. We found other institutional investors. He and I were out raising capital, trying to raise it from private individuals. We had raised almost $100 million from friends and family into the core entity, our core company, using a very creative method of selling LLC units of different types and preferred stock and all sorts of things. And finally, in 2003, we were both very committed to the growth. And we had a partnership, and he was running the day-to-day. And what he did was he said, well, Ken, if we're going to build a real company, we got to have a good IT guy. We got to have a good marketing person. We got to have a great CFO. We need to have a good legal officer. And we need to have a top-notch operations person. And we didn't have any of those. So we went out and hired people who were really competent for each of these skills and built a team and sucked up the negative cash flow of all that overhead for a couple of years, which turned out to be a really good decision. We also were generous in giving stock options and pieces of the company to these various executives we hired so that every one of them became multimillionaires. And it was a good idea, I think. Initially, we were not a technology company. Now, you think about storage. Storage is the garage business, right? You know, our biggest competitor is the dumpster. And that's our competitor. So why do we need an IT department? We hired a really smart IT guy who had built, and he said, hey, this IT stinks. There's no good software in this. Let's build our own software platform. So we built our own software platform. At the time, the internet was not pervasive enough that you could have fast internet at all the properties. So we had to set up huge satellite systems. And by the year 2000, just a year and a half later, we had an operating system which every transaction that took place at every property we owned, and a typical property would have 600 tenants, every unit rental, every cash payment was automatically in our Oracle database instantaneously all the time. So I had instant access to data, and we made data and having access to information a very key part of our strategy. Well, of course, a few years later, fast internet came, everything happened over the internet, and we eventually took that software business that we had created and spun it off so that it could market our product all over the self-storage business industry, which we did, and it was called Center Shift. But we became a technology company. Now fast forward, 2003 runs around. Fall, it's October, or maybe early November, and I was in New York with Spencer, Kirk. We were meeting with investment bankers trying to figure out how to raise more money. We're getting exhausted. And the banker says, you know, you ought to consider going public. And I'm going, oh, I don't want to go public. Why do you think I didn't want to go public? Do you have an idea? Lose control of the company, regulations, I would be in the spotlight, everything is known to the public. You no longer, as an individual, can leverage, you can't make deals to get promoted returns because you're now a shareholder like everybody else. You get, whatever your shares do, everybody else's shares do, and they all go up together or they go down together. And the bigger you get, the harder it is to grow the thing. It's easier to grow a small thing. It's easy to double something that's 100 million into 200 million. It's much harder to take something that's $1 billion and make it go to 2 billion, or something that's 5 billion and make it go to 10 billion. So I knew this, but I also knew that we were lacking capital and that we really needed the capital. And I remember that morning getting up, couldn't sleep. I got up at 4 a.m. and I walked for 3 hours up and down the Park Avenue in Manhattan, trying to figure out what to do. Finally made it, after talking to my wife, we made a decision, okay, we'll go for it. A week later, my partner, Spence Kirk, got a call from the LDS Church, and he was asked to go serve as a mission president. Many of you know what that is. So he said, okay. And then, you know, we were going public, and we needed each other. And we said, okay, let's see if we can get public before you leave. Well, this was November now. We thought we could get public by March. Well, we didn't get public till August. It was very complicated, very difficult. And he went on as a mission president, and I took over solely alone. Well, what was really hard about it was this relationship with Prudential, because in order to go public, we needed to buy out Prudential from a lot of their investments. And they were happy with their investment, and they didn't really want to sell. And so we had a very difficult, protracted negotiation. And at one point in the negotiation, our attorney said, you know, Prudential's not being a fair partner. We should go after them and sue them. And I said, no, we don't sue partners. They're not being fair. He said, no. I said, I understand, but we'll work it through. Well, we eventually worked it out. They kept some of the properties in a joint venture. They sold us others. They were happy. We went public in August. And one thing I learned about going public is, you know, some of you watched some of these public offerings. How many of you watched Facebook? Remember Facebook when it went public? It went up like this, then went down. Now it's up again. But there's no guarantee when you go public your stock's going to go up. And in fact, often the investment bankers, they will tell you that they're working for you. But my impression is they really aren't working for you, the company. They're working for the shareholder or the investor who's going to buy your stock, because they want to look good that the stock went up after you went public, which means that you get a lesser price than maybe what the company's really worth. And so we expected to go public at 15. We went on a big road show. We had all these things. And when it came out, the bankers said, well, we can't go public at 15. The market's deteriorated a little bit. We'll do it at 12.50. And we were about ready to say, forget it, because it was really diluting our interest a lot to go public at 12.50. In the end, we sort of sat there in the room, my CFO and I, and Spencer was on the phone from his mission, and we agreed to bite the bullet and do it. And we raised $290 million in August 11th, 2004, which at the time was the largest public offering of any company ever going public in the state of Utah. And then I thought about, okay, now we're public. Well, I had been eyeing a larger company. I mentioned Storage USA up here. Storage USA had been a public company. They had grown to 450 properties. and they were acquired by GE Capital. And I knew that it wasn't going very well at GE Capital. When we went public, we had 130 properties. So before we went public, I was on a ski lift. By the way, this is a good way to do business, by the way. Here, you live here in Utah, take your clients skiing, they like it. And I was on a ski lift with the head of GE Capital Real Estate at Deer Valley. We were going up the lift, and I said, hey, you know, how's the storage business going? He says, not very well. I said, well, why don't you sell it to us? We can do a better job. And he said, I can't sell it to you. You're too small. I said, yeah, but we're going to go public. He says, well, then get public and come talk to me. I said, okay. So we got public, and I went and talked to him. And one thing led to another, and they decided to sell their company. What I was hoping is a joint venture with us and GE. But then GE decided, no, we're going to sell the whole thing, and they hired an investment banker to sell it. So I thought, oh no, Public Storage is going to bid, SureGuard is going to bid, other private equity groups are going to bid, and little extra space. Now, you got to remember, at the time, we had a market cap of about 600 million, and the price of this company was 2.3 billion. And they had 450 properties, we had 130 properties. And so we signed an agreement with GE that allowed us to go shop this, because we knew we needed a partner. And we shopped it to New York Common Fund, the CalPERS pension fund, and the government of Singapore. And they wouldn't let us, GE wouldn't let us shop it to Prudential because they said Prudential was too small. And I remember afterward going to the GE guy saying, listen, we haven't had any luck. He said, yeah, your price is too low anyway, so don't worry about it. We have other bidders, your price is too low. And I said, well, let me go talk to Prudential. And he said, well, you have to come up on your price. So I raised the price for 100 million. Now, I had never negotiated in increments of 100 million in my life. But I knew I either had to go up by 100 million or else it would fail. You know, I wouldn't get the deal. So he said, okay, go talk to Prudential. So I went and talked to Prudential and said, yeah, we're very interested. So that was on a Thursday. The following Thursday, I was in Prudential's office in New Jersey with my CFO and a couple of other people, and we made a presentation as to why this is a good deal to buy this company. And we figured we could raise 500 million in the markets, but we needed 1.8 billion from Prudential. And they had their fund manager sitting in the room, and they went around the room and they subscribed the full 1.8 billion by raise of hands around the room. One guy said, I'll take 700 million, another guy said 500 million, and 300 million, 200 million, around with 7 different funds. I was like dumbstruck. They really liked the deal. The next day, they gave me their hard commitment for 1.8 billion. And can you imagine that? Getting a commitment like that? Well, make a long story short, the Prudential guy and I went and negotiated with GE, and we ended up buying the company. It didn't close till July of 2005 for 2.3 billion. Now, you'll be interested to know, why do you think Prudential invested 1.8 billion with extra space? I asked them that. Why did you do this? We were a small company. They said, you know, and it was the largest investment they had ever made in their real estate fund, ever. And it was on storage, which was not a normal, it's not office buildings or hotels. And the guy told me, he said, you know, you treated us really well as a partner. You've always been a good partner to us, and we liked the way you treated us, and we knew we could rely on you to do a good job. And then I thought, wow, what if I had sued them or had a fight with them when we tried to go public? We didn't do that. We took the high road. What if I hadn't paid that $275,000 note? I wouldn't have got the first 150 million and then the $1.8 billion from Prudential. They're still a partner today. We have a great relationship. We have 250 properties in partnership with them, and it's just a wonderful relationship. Well, that sort of built our company. We became the second largest operator of storage in the US. It took a lot of work to integrate the two companies. I spent the next year and a half not doing acquisitions, not doing anything else but operations, and getting it all functioning together, because we had all these employees. We went from, I don't know, 500 or 600 employees to 2,500 and people over the country. And I went personally to, I don't know, 45 town hall meetings in every city in the U.S., and I personally visited over 500 properties and really got to know the business. In 2008, not 2009, we started the Management Plus program. We realized what was happening is the internet was becoming important in our business. Before 2008, most of our business came from Driveway or Yellow Pages. And the typical self-storage customer is there for 12 months on average and then leaves. So you're constantly replacing your tenants. Well, now, what's happened to Yellow Pages? Zero. Everybody goes to Google, right? Or Bing, but mostly Google. And they look for storage. And there's paid ads, paid search, and there's natural search. And what's really become, what we thought originally that the internet would become the great equalizer. But not. It's not the great equalizer. It's become the great divider. And the bigger companies such as us have a huge advantage. And what that's led to is we now have 42 people working full-time in internet interactive marketing at our company. We bid on 9 million terms a day for storage. We have to have specialized sites for Apple versus iPods versus the different operating systems for the different mobile. This year, mobile is surpassing desktop. So your mobile devices. So if you have your iPod or your iPad or your iPhone and you look up storage, this is a good example. I was in Chino Hills, California the other day, and I Googled self-storage Chino Hills. Up comes Extra Space, first on paid search, first on organic search. Click on our website. Our closest property is 10 miles away. That's a long way. You don't want to go 10 miles for storage. There's a guy called Chino Hills Self-Storage a mile down the road. He wasn't even on the first page. Well, many customers will hit us and they'll go 10 miles and rent from us. And so what that's led to is outsized increases in income. Now I'm going to click through this presentation because we're getting... Today our growth is coming from we do third-party property management. We manage 250 properties a year, 250 properties for other people. Core property performance, lease-up properties. We're doing a lot of acquisitions. Last year, well, we'll show you the acquisition pipeline. This is our performance compared to the other REITs in our business. This is 32 quarters of same-store outperformance. You'll notice that green is Extra Space. Orange is Public Storage, which is the largest. Red is CubeSmart, and SSS is Sovereign Self-Storage. You'll see that we've outperformed through the good times and the bad substantially our competitors. We currently have 1,029 properties in our system in 35 states. We own 506 of them. We have 273 in joint venture, mostly with Prudential, and 250 that we manage for other people. This is where we're located. All over the U.S., in the heavily populated areas, mostly. Not much in Utah. This is our acquisitions that we've been doing. Last year, we closed on $585 million, 78 properties. I personally negotiated about $400 million of that. So that's what I've been doing as chairman, is buying a lot of larger deals. Here's some of our properties. Kendall, Florida, some that we built. This one looks more like a hotel. It's too much like a hotel, and it didn't rent very well because of it. But this is not a storage shed, right? Okay. This is in Los Gatos, California, Fort Lauderdale, Florida, Oakland, California, Santa Monica, California. These are our company goals. Maximize customer satisfaction, provide an excellent product and an excellent service. And this is an important goal. Develop and maintain mutually beneficial business relationships. And that really means anybody we do business with, we want to have a positive relationship, particularly smaller companies and vendors and things. We want to treat them fairly, and we work with our people to do that. We want to grow. In any business, you should grow or die. You don't want to have a strategy of just maintaining. Maximize shareholder value and make Extra Space a great place to work. And then lastly, these are our company values that we value in our people: integrity, excellence, innovation, teamwork, and passion. Our company is the leader in our field today in terms of growth, in terms of technology, and we have been the leader in the last 5 years. I think we're number 3 in overall return of all real estate companies. In the last 4 years, we're number 1. The last 3 years, number 1. The last 2 years, number 1. It's a pretty extraordinary story, and it's headquartered here in Utah. Now with that, I know we'll just have a few minutes. Isn't that right? We have to go till 7. I'll just take a few questions. Yes.
Is that me?
Yes, you. Thank you.
How do you go about finding out who you want to be a partner with? Because that's a pretty big decision. And sometimes it's hard to tell how to, the characteristics of a person.
There's not one simple way to find a partner. I mean, in my case, I had worked with this person closely in a different business and knew his personality and knew his capabilities. He's our CEO today. I went on an LDS mission in 2009, left the company. He took it over. He was on a mission when we went public and did that big acquisition. He's done a great job running the business. I had another very significant partner I met in England just through a business transaction. We became good friends. You need to be friends. I don't have a solution except that you need to know the person. You don't want to just go into a partnership with somebody you don't know well. Other questions? Yes.
So you mentioned early on that one of the keys to your business strategy was that when you started again with extra space storages, you wanted to focus on extra space storage and kind of eliminate a lot of the other things you're doing. How do you focus on one area and then also diversify your risk? Because I imagine that's what you were kind of doing with a lot of those other joint ventures, was diversifying your risk.
You know what? It's hard to do that. And the reality is I'm still not the most focused person in the world, and I still have other business interests, and I've done a better job than in the past of focusing. But the reality is, part of being an entrepreneur is going for it. Focusing, which means you take the risk that it all goes down. I mean, that's part of what you do. I feel like our diversification of risk is diversification within the company across geography, which is, and it's a tremendously, we have 600,000 customers. That's a very diversified group of tenants. But you're right, you can't totally diversify it. But I also think diversification is usually a way to have suboptimal investment returns. And I think it's true in the stock market too. Other questions? Yes.
What was it that inspired your transition from physics to business? I'm an electrical engineering major, love the concepts of business, but I don't know if I see myself getting there. What made that decision for you?
My dad was a businessman. He really encouraged me to go into business. I always had an entrepreneurial interest. I mean, even when I was a physics major, I started a business importing cars from England and supported myself through undergraduate and graduate school. So I always had a natural interest in, I had a business in high school. So this went way back with me, I suppose. And I just realized that that was more my calling than being a physicist. Even though I was good at physics, I liked it. It's interesting to me. Yes?
With the extra storage, do you have goals to take a certain percentage of market share away from the market, or to grow into?
No, because we're still a very small, there's 55,000 self-storage properties in the U.S. We have 1,000. Market share is not that important, but it never was that important until now. What's important now is how big you are because of the internet. And so now that we're 1,000 properties and our competitor's 2,300, he's got a stronger position in the internet than we do, and we're double the size of the next 2 competitors, and we have a stronger position than them. We need to grow our platform. We need to surpass them, and that's what we're trying to do now. We're thinking of doing things like franchising to increase our platform so that you can see extra space storage in every city. We'll never own a storage property in Logan because of the demographics of Logan, but we might franchise one and have an extra space that we don't own, but that we provide all of the ancillary services, the name, you know, a little like a Wendy's restaurant or a Marriott hotel, that kind of thing. Okay, I think we're about done.
How big do you think you can grow?
I see us growing in size to be 4,000 properties, and I can see our market cap being 15 billion. I think it's going to happen. I think there's more opportunities today in some ways than before because there's no capital restrictions. Being public has given us capital like I never could have dreamed of, and it's so easy to get it. It's unbelievable. It's incredible. I mean, if you want, let's say you need to raise 300 million, you can call up the investment banker, and 10 days later you have it in your bank. It's literally that easy. It's incredible. So, all right, thank you very much.
Everyone, on behalf of the school business, we'd like to give Ken here a token of our appreciation, and thank you again for coming. Appreciate it.
Thank you very much.
Thank you.